and welcome back to yet another exciting week of the Lazy Money Game. For all the regular followers on this channel, I of course have to start by saying that I'm sorry for not having produced an episode for the last 2 Sundays. Unfortunately, I myself have been hit by this global pandemic, hence I have not been in a state of mind where it was possible for me to actually produce these episodes. It was just to tell you, if you were curious, that is what has actually happened. So now that I'm feeling better, I will keep on producing more content on a regular basis again. So this week's episode, I will cover the 3 weeks and what has happened within the portfolio, and then I will look into an article from NBC News regarding Robinhood, and then finally I will answer a question which I have received from the audience as well. So let's start with a portfolio update. Since I haven't given an update since week 25, then I think it is actually good that I managed to take some screenshots so you can actually see how the portfolio had developed in week 26 and in week 27, and now here again in week 28 when we go back and look into the Google Sheet. So here's a screenshot from week 26. You can see how all the companies have developed in the value. You can see that my portfolio is down in value compared to week 25. If we then go forward here to week 27, once again, you can see the development in each individual company. It is really important for me that I actually show you how this portfolio is performing week by week, so that I'm not hiding anything, so you can have a real life example. And if we then go back to my Google Sheet, just to show you the development of week 28. So looking at the fluctuations for week 28, which you have on the screen here, you can simply just pause the video if you want to have a closer look of each individual holding, but otherwise I will just scroll down here so you can actually see the value of the portfolio. Then once again, there should be a red circle for this week's episode, and this is actually 3 weeks in a row where we have seen the portfolio being declining in value. And just to illustrate it more clear, if you go to the Portfolio Values tab, you can see it very clearly illustrated here on the blue line that it is actually declining. So since the peak of $164,000, the portfolio has actually lost a bit more than 6,000, or at least it has fluctuated, since it's not an actual loss, since I have not realized it. But if we then continue to my favorites tab, namely the dividends tab, then we can see that a lot of things has happened in here over the last 3 weeks, since I now have received a little more than $355 within this month so far. And the companies which has paid out since I made a last episode was South Jersey Industry with a little more than $51, Merck with a little more than $110, Cardinal Health with a little more than $16, and then finally the biggest holding within my portfolio and at the same time the biggest dividend contributor was Store Capital, and they have paid me a little more than $165. So when I look to the number here, 355, and then go 3 months back to compare, well, this truly looks amazing, since I have managed to increase my passive income with way more than $100 in that month. And just to continue the comparison here, July 2021, 355, July 2020, 56. So more than 6 times more in passive income compared to last year, or close to $300 in additional passive income. Of course, I know that I have been adding a significant amount of money into the portfolio, and I would be nowhere close to seeing the passive income stream if it wasn't for the fact that I have added so much additional capital. But this truly shows that it is possible to build a stream of passive income if you are actually consistent with your investing and keep adding money into the portfolio. And just to illustrate the example here even more clear, well, if we go back to the Portfolio Values tab, then we can see that I have added $147,000 in total into the portfolio by week 28 of 2021. So if I want to figure out how much additional capital I have added, well, then let's go back to week 27 of 2020. there you could see that I have added $81,000. So the difference between $147 and $81 is $65,000. That is how much additional capital I have added in order to increase my passive income by more than 6 times, or from what we saw back here in the dividend sheet, $56 on July compared to $355. If we then continue to the article from the NBC News, I will of course as always leave a link in the description below so you can go and read it for yourself. Robinhood to pay a $70 million fine for false information and trading outage in the largest ever regulatory fine. So I actually saw this article when I was trying to research for the episode that I was supposed to do 3 weeks ago, but unfortunately due to my health situation I was not capable of making the episode. But I still think it is actually quite important to read through articles like this, because this really confirms the words of Charlie Munger that you should only invest your money via a broker that you actually trust, meaning that they have a really good history of treating their customers good, and they should have a long time span for which they have done so. So in this article they go through why Robinhood have to pay a $57 million fine for not having the right due diligence on their customers, meaning that they have let some of their customers trading options where that was definitely not a suitable product for their customers to be allowed to trade, and for the same time not having the infrastructure or the robustness of their platform, so a lot of their customers could actually not trade during one of the worst market crashes that we have ever seen in March last year. So on top of this fine of $57 million, they have also been fined to restitute $30 million to all those millions of customers who could actually not do their trading due to this outage. And at the same time there was a lot of misinformation by Robinhood, so this is actually really severe. And everyone who has been trading in GameStop this year also know how much Robinhood limited their clients' possibilities to trade more of GameStop, and that they severely limited the amount of shares that each customer were allowed to trade, and at the same time completely shutting down for the possibility of trading options. So when you are thinking about using a broker and how much you have to pay when you use a broker, you really have to remind yourself. I mean, I'm still shocked about how Charlie Munger really hits the nail on the head when he says you have to trust the broker which you are using, and perhaps you are better off paying a little higher price for actually getting the service that you need. For me personally, this has really put things into perspective, since one of the reasons why I started this YouTube channel was that I discovered Revolut, where I could do commission-free trading. But what I later realized was, well, I actually didn't get the service that I wanted. And then of course, when we saw all these other things about massive fee increases of a factor of 12 and severely lowering the amounts that you are allowed to exchange and so on and so forth, well, then I mean, I'm really happy to see zero commission trading, because that allows more people access to the market and to get started. But at the same time, perhaps it is actually more important that you don't get started too soon and then spend more time on actually increasing your savings. So when you start on a broker that you actually trust. I'm not saying that you necessarily can't trust Robinhood or Revolut. It's simply just my personal discovery about finding that, for instance, I didn't get that company information updates about a spin-off in a company and other things which I as a shareholder actually really appreciates receiving. So in economic terms, you would have phrased it as there is no such thing as a free lunch, meaning if something sounds too good to be true, it probably is. So let's continue down this path and say, what is the costs of free trading? Well, once again, if you listen to Charlie Munger and Warren Buffett, then they would say there's a big difference between gambling and investing, since gambling is focusing on the short term with a high uncertainty, since no one knows what is going to happen within the next hour or within the next 24 hours. And then comparing this to investing and saying what will happen in 10 or 20 years from now, where it is more likely that you have a better idea where it is actually going, since the stock market goes up in the long run. So this is actually really connected with a question that I have received from the audience. What is the costs of free trading? And let me try and answer that question with one of the not so obvious costs when it comes to free trading. So the more you trade, the more likely you are to lose your money. Meaning, if you do day trading or short-term trading, meaning that you have a higher trading volume, well, the more likely you are to lose your money. This is not just a statement which I'm saying and making for you. You can simply go and Google this and find plenty of financial articles. I will show you just in a bit, but let me continue here and try and explain a bit more why this is. So if we start with the psychological aspect, well, if you think about trading at something that costs you nothing and you can do it with a click on a button, so it's really easy for you to do, well, then all of a sudden, then you are more tempted to be ruled by your impulses and your emotions. And if you are ruled by your emotions when you're doing trading, then you are definitely more likely to lose money, since you should be dealing on facts and not on emotions. And just to add a bit of humor to this, allow me to quote a movie like Wall Street, where Gordon Gekko says, "Nothing ruined my day as losses." So in order to be successful in the trading environment, you of course have to be really good at dealing with your emotions. And on top of that, you can put this overconfidence into the equation as well. Simply saying that most people believe that they are better than the average, so they are naturally inclined to think, of course I can do better than average. And as I promised, you can easily go and do a Google search like this, do investors trade too much, and then simply check out some of these articles where you can easily see in the conclusion, at least I know they are quite technical, so I'm not trying to go into this or trying to explain this in any detail whatsoever, but if you're just reading the conclusion here, you would see that they are really clearly stating the more you trade, the more likely you are to have a loss. So this was just to mention a not so obvious cost first. If we then want to look at some of the more obvious costs, it would be something like these three listed here: the bid-ask spread, the currency exchange, and the payment for order flow. So if we start with the bid-ask spread, if the stock is quoted at $100, then if you're buying it, you're paying $100.01, and if you're selling the stock, then you're selling it at $99.99. So in this case, the bid-ask spread is 2 cents, and those 2 cents goes to the market maker, meaning that they will make that difference in profit. And in general, the more liquid the stock you are trading, the smaller the bid-ask spread is. So if you are trading on some of the stocks that has a really high volume, then the bid-ask spread tends to be much smaller, like 1 cent or 2 cents. But if you're going to trade on small cap stocks, then the bid-ask spread can actually be quite significant. And the currency exchange is very naturally, well, I'm a Dane. If I buy and sell in Danish kroner, then I have no currency exchange. But if I'm doing, as I'm showing here, buying the stocks in US dollars, well, then I will have to pay a currency exchange every time I'm buying a US dollar denominated stock. And those currency exchange rates can vary quite a lot from broker to broker. And the third option here, payment for order flow, is of course the one which is a little more technical to describe and explain here, but it means that the broker routes your order to the market maker, and then the market maker buys and sells on their own inventory. So this has actually led to some controversy, for instance, regarding the GameStop stock, since Robinhood got money from Citadel Management, which at the same time was the market maker which they were selling the order flow to. So Citadel both knew how many buyers and sellers of GameStop, for instance, there was in the market. So in a lot of countries, you're actually not allowed to do payment for order flow, since if you as a market maker actually make your money on the bid-ask spread, then you will all of a sudden here have a conflict of interest, since the larger the bid-ask spread is, the more money you will make yourself. And as a final point to note here is, these costs are not limited to free trading. So even if you pay a commission, you will still pay a bid-ask spread. There will still be a currency exchange if you are dealing in foreign currencies, and you can also risk paying for this payment for order flow. So it's not that I'm against free trading at all. I'm simply just saying there is no such thing as a free lunch. So you will, even when it seems that you are not paying anything for your trading, you are actually paying something for it. So that actually sums it up for yet another exciting week of the Lazy Money Game. So now you have once again seen the development of my portfolio. You have seen this article regarding Robinhood and the big fine, and hopefully you have now learned the valuable lesson about why it is so crucial that you have the right broker, and why I actually think it is very important to go with a broker that you actually trust. And finally, you have hopefully learned more about the costs of zero commission trading. And until I see you next Sunday, bye!